Hello, everybody. At Yardeni here. It's December 22nd, and I guess everybody's getting ready for Christmas. Hope some of you have had a good Hanukkah. And New Year's is around the corner, and uh, my wife and I decided we'll be home for the holidays, so we're not going to uh, compete with everybody else in the airports. Anyways, it's a nice sunny day here, a little bit on the cold side, but it is winter, but no snow. We had some snow the other day, and we had a rainstorm that melted it all away. So here we are. Now the question is, will this rally melt away? And shows no signs of doing that whatsoever. It seems as though the Santa Claus rally is getting set here. I guess there's different definitions of what period of time the Santa Claus rally starts and ends. I think everybody agrees it ends at the end of the year. But in terms of when it begins, I kind of like to look at November and December. Those tend to be two really pretty good months for the market over the past 10 years. Those 2 months have added around 4%, 4 percentage points to the S&P 500. So I think that's a pretty good Santa Claus rally on average, and looks like the S&P 500 is doing that and then some. The average increase in the S&P 500 over the past 10 years has been about 12%, and we're right now up 16.5%. So again, I think we've already started our Santa Claus rally, and I think we'll probably won't be given very much of it back between now and the end of the year. What's driving the market is earnings, in our opinion. Analysts remain very bullish. They've actually become more bullish at the beginning of the year. They were very cautious about the outlook for earnings. They lowered their Q1 and Q2 estimates as before the reporting seasons, and they did so pretty aggressively. And I think they were obviously spooked by Trump's tariff turmoil. I think some of them were also spooked by DeepSeek, which was introduced in late January. I think a lot of people still believe that the sell-off at the beginning of the year was mostly tariff related, but I would argue that a lot of that was also DeepSeek related, because DeepSeek, the Chinese firm, came out with a open source LLM that apparently was trained much more cheaply than the LLMs by the hyperscalers here in the United States. And suddenly the question is, why are they spending all that kind of money if it can be trained on cheaper chips and can be done more cost effectively? And the hyperscalers gave their answer during the first and second quarter earnings seasons. They basically said, no, we think we need to have all these data centers. We need to have state-of-the-art NVIDIA chips. More recently, it's turned out that OpenAI is not the only LL game in town. That seemed to be the perception for a while, that OpenAI had the LLM, that ChatGPT and Copilot. Copilot is basically ChatGPT. So the idea was they seem to be the front runners for sure. And then Gemini 3 came along. And there are other LLMs that are really quite good or comparable in what they do. And Google's Gemini 3 ran on TPU chips as opposed to GPU chips. And the TPU chips are internal, so suddenly there's more competition. And we've been talking about this for the past 2 weeks, maybe 3 weeks, but we've been making that Game of Thrones analogy that until recently, these Magnificent Seven had their own seven kingdoms, fiefdoms, and had big moats around them, and they didn't have to compete very much with one another. They had their own very good businesses to run, and they were kind of quasi monopolies. What changed over the past several weeks is the perception that AI is actually forcing them to compete with each other. There's sort of an AI arms race, as it's been called, to build data centers and to continuously offer better and better LLMs. And people are saying, well, are they ever going to make any real serious money on the LLMs? Will they ever have a rate of return a return on investments from all this data centers that they're spending money on? The answer is probably yes, but there's a lot of uncertainty around that, and there's a lot of uncertainty with who will actually be the winner from this whole race. And of course, I think I read somewhere kind of a clever quote that these by the time they build all these data centers with state-of-the-art chips, they will have already become obsolete because along the way something else will be introduced. Clearly, there's still a bit of hype here right now. Some of the hyperscalers, some of the heads of the hyperscalers, like the head of Elon Musk, the head of a bunch of companies, and the head of Google, and I think also Jeff Bezos have been saying that they're now looking into putting data centers in outer space. Now, Amazon has that capability to put satellites out there, but certainly Tesla, the SpaceX has that capability. But we're still thinking that in 2026 the market will broaden out from the Magnificent Seven to the impressive 493. We're still thinking that it's hard to overweight information technology and communication services. I mean, you can do it, but you got to have more than 45% of your portfolio in just those two sectors. And of course, to overweight the Magnificent Seven, you've got to have more than 30% of your portfolio in just those seven stocks. And the reality is, if AI is the real deal, then the real beneficiaries may be the users, not the producers, but the users of the technology in terms of increasing productivity, increasing their profit margin, and so on. Well, that clearly is an important issue up ahead here. Another important issue, of course, is what the economy does. I just tried to find GDP and I couldn't get it. So if anybody saw it, just give me a little message of what it was. But we're expecting 3.5% for the third quarter, following a 3.8% increase in the second quarter. And I guess we're going to find out here whether the economy can continue to keep up this pace of growth when the labor market really isn't growing at all. Real wages are still going up, but the pace of hiring, net hiring, has basically gone down to about 30 to 60,000 per month. And it looks like the market, we all kind of got used to the idea that that might be the new normal in the labor market. So it doesn't seem to be an issue for the market at this point. But if we did get a situation where the labor market continued to generate a pretty small headcount for new employees, and we started to see that retail sales were really quite weak, then we have to worry about the consumer-led slowdown, and something worse. So that is an issue, an open issue up ahead here. We're still in the camp that says that the economy's been resilient over the past 4 years, and it'll remain well since the beginning of the decade. Let's make it a roaring 2020 story, and that the economy will a GDP third quarter came in at 3.5%. I just saw. Okay, thank you, William. I appreciate it. So that's as we expected, and to be honest here, that's as we expected, because that's what the Atlanta Fed tracking model has been expecting, 3.5%. So we rely on them. They do a pretty good job, we think. We also, by the way, look at the Cleveland Fed's nowflation tracker, and that seems to be pretty good as well. And that was closer to zero point 0.3 than the zero point 0.2 for November. The November CPI was good news, but I think everybody concluded that it might have been kind of a wacky number because there were so many components that the Bureau of Labor Statistics didn't have. Um, then, of course, there's a matter of where this market goes. Well, if the economy is going to remain resilient, then the valuation multiples may continue to remain resilient around 22, which is where they are right now. Valuation multiples take a dive during corrections. Earnings hold up, but fears of a recession bring the PE down. But it's a correction because you don't get a recession and earnings keep growing. You get bear markets when a recession actually occurs, and then you got whacked from both variables. You see a PE multiple going down, and then you also see earnings going down. But if there's not going to be a recession between now and the end of the decade, and maybe there won't be a recession, but there'll be rolling recessions that affect different industries at different times. But on balance, the consumer hangs in there, capital spending hang in there, and of course, nobody's really in our business is a big fan of the federal deficit, but it is a source of stimulus to the economy, particularly interest income and of course social entitlements and all that. Um, if that's the case, then the valuation multiple should hold up. I think that productivity is going to continue to make uh, strides here to the upside. It's going to be better than expected. And if that's the case, that should keep a lid on unit labor cost inflation, which will bring inflation down. So count us among the optimists on inflation. We have been saying that inflation would have been down to 2% by now if it hadn't been for the tariffs. Tariffs, I think, have caused inflation to stall around 3%. And you can see that in the durable goods inflation rate. It had turned slightly negative into deflation, and now it's slightly back up again. And that swing made all the difference in terms of getting down to 2% versus getting stuck here at 3%. But we do think that as we get into the new year, productivity, unit labor cost inflation will be driven down by productivity gains, and that we can get an inflation rate of 2%. If that's the case, then the Fed isn't going to be raising rates. Nobody's going to be talking about higher rates. Maybe the bond market will continue to settle down here. And north of 4%, we still have a deficit issue. We see that the administration is scrambling, kind of frantic, in a frantic way, realizing that they've got a problem here with the midterm elections. Mamdani winning in New York City and what happened in Virginia and I think Pennsylvania, with the Democrats winning a few elections there, that made the administration realize that maybe the focus on tariffs was the wrong way to go, and they really should have focused more on getting prices down. And so now they're scrambling to do that, but you can't really get prices down. Maybe you can get some prices down, but you can't bring inflation the price level back to where it was. And so what they're doing is we've seen the president say that people are going to be getting checks for $2,000 sometime in the first quarter, and that on top of that, they're going to be getting bigger refunds than usual because of the big beautiful bill was retroactive to the beginning of last year. So there's going to be a lot of fiscal stimulus in the first quarter and in the second quarter, and the bond market may not like that at all. That's got to mean that the deficit's going to be bigger, so we could have some shockers there, and maybe that's really the thing to watch out for, is that all that stimulus, while it might keep the economy growing at 3 to 4% and might allow productivity to continue, it will widen the deficit. Bond market, the bond vigilantes may protest, and maybe that'll be good for a correction sometime in the first half of the year. So we'll be watching out for that kind of scenario. But all in all, the earnings outlook looks pretty good for next year, and we're looking for It looks like this year's coming in about $270 a share for the S&P 500. We'll get the final fix on it when we get the fourth quarter numbers for the fourth quarter numbers in January, February of next year. But it looks like about $270 a share this year. Looks like about $310 a share for 2026, and we're using $350 a share for 2027. Uh, that $350 a share, we think, is what the market will be anticipating for 2027 at the end of 2026. 350 times a PE of 22, and you get 7,700, which is where we think the S&P 500 is going to go. And we still think it's going to go to 10,000 by the end of the decade, by the end of 2029. And if the S&P does that, we think gold could get to $10,000 an ounce by the end of the decade. Now, gold, I got a problem. I haven't been bullish enough. I thought I was pretty bullish. Certainly seemed that way. At the beginning of the year, we got to about $3,000, and right around then, I said I thought we'd get to 4,000 by the end of the year, and now we're at 4,400 last I looked on the screen. And I thought we'd get to 5,000 by the end of next year. Now I'm kind of wondering whether I should make that 6,000, and maybe I will. I'm going to sit down and write a quick takes at some point here on gold, giving you an update. But let's have some fun and look. We always have fun, I guess, together. Let's. Sometimes I screw things up on my end here, but let's see if I got this going here. Let's look at some charts. Here's gold. By the way, I appreciate this very nice turnout when I think a lot of you are probably tuning in from the beach somewhere. So here's we have this gold. We call these things web pubs. They're on our website. This is the one for gold, and here you can see gold going to the end of 2027. But well, we're taking a roaring 2020s look, and so that's this chart here. And you can see that when it broke out above this level here into the 3,000 range, uh, we started talking about 4,000. Um, and then we talked by the end of the year. And so we're already there, and we're at a new record high today. They say it's on Venezuela, but there's clearly a lot of factors driving gold higher. Uh, and none of them that are terribly scientific or can be put together in an equation or a chart showing a direct correlation, except one. I'll show you that in a minute. Um, so 5,000 by the end of the year, probably raise that shortly, and then 10,000. Now let's go to a chart that is the one we kind of created. It is the, the one chart that has some analytics to it or some logic to it, I would say. So in the early 70s, Nixon closed the gold window, and so the price of gold took off. It was around $40 per ounce. Really took off here. It did a five-fold increase, so that shows you what it can do. Then it kind of corrected a bit, and then it resumed to an increase to $800, which is a 20-fold increase. So that was great. And then we got hit by the Hunt silver crisis, and the price of gold took a dive, got cut in half. Still a substantial gain from where it had been. Then kind of drifted lower, and everybody kind of got bored with gold. Meanwhile, the stock market, and by the way, these are on the exact same scale, all right, which is kind of makes this kind of a horse race. Is who's ahead here? So the S&P, the gold was the winner here, and then it kind of faded. Then the S&P, meanwhile, kept climbing and making people money while gold wasn't. Then we had this big rally in the late 1990s. So who wanted to be in gold when the S&P was so much more fun? And then the S&P wasn't as much fun. kind of the lost decade here, if you will. Um, and meanwhile, gold resumed its climb and looks like it went from what, about 300 bucks to 2,000 bucks. So that's a pretty impressive gain. Then again, we had this period where it stalled out. And here again, we're seeing it move to catch up with the S&P 500. You'll notice there's an inverse relationship between the S&P and gold. There's nothing statistically significant about these because it's only really three observations, but it does suggest that gold has actually been a pretty good way to um, diversify or balance a S&P portfolio so that when the S&P is flying, it's not doing so well, but when the S&P isn't flying, gold's doing very well. Here we got this horse race where we're at 4,400 on gold, and the S&P 500 is at almost 6,900. So we're thinking that if the S&P gets to 10,000 by the end of the decade, gold may uh, has a shot of getting there. Or maybe it's some sort of global rebalancing. Is that, people, when people make a lot of money in the stock market, they get nervous for one reason or another and decide to take some of their profits and put it into gold. Or maybe this is a totally spurious relationship that will at some point stop working. I've had these situations where I could show you on a chart an amazing correlation, and then it stops. I think we had one between the price of gold and the TIPS yield, which worked pretty well for a while inversely, and then it stopped working. But anyways, this one is still kind of our go-to kind of fundamental technical explanation for what gold is doing. Let's look at the quick takes. We're not doing morning briefings. Let everybody off. Uh, Not everybody views doing this stuff as a hobby the way I do. Some people actually view it as work and need a little bit of a break. Hey, look, we're all having fun here at Yardeni Research doing this, but it is the holidays. So let's have a look here. This is the what I want to do now is just focus on the S&P 500. I said it's going to 10,000 by the end of the decade. We've talked about it before. This shows you the S&P 500 year-to-date performance. This year we had that extraordinary roller coaster turn out to be a big buying opportunity. We got flipped around a few times on that roller coaster. We started at 7,000, and I think we got down to 6,400 somewhere along the way here, maybe a little lower than that. Still remain bullish because the market was below where we were saying the year end could be, and then like everybody else around here, we realized that maybe these tariffs weren't going to be all that disruptive after all. And I was arguing that the administration would want to get this issue behind them by the summer so they could start focusing on the midterm. And the problem with something like this is politics is a messy business. It's never so cut and dry. And then, we got the Supreme Court about to rule in January that this was all unconstitutional anyways. So then we'll have the mess of how the administration deals with that. But meanwhile, the stock market has had a roaring, great year, roaring 2020s, roaring 2025. We had this sell-off here, which kind of brought it in line with its 10-year average. And here's what I mentioned before. I think you can see that the 10-year average has increased. Well, I guess we went from about 8 to about 12 and a half. So it's about a 4.5 percentage points. And here we are kind of getting that back, but the return is more, 16.2% versus 12.3. If it turns out to be 16.2% or 17, 18%, this will be the third year in a row of double-digit increases. We had two above 20% the past 2 years, and now we could have another one right below 20%. And then for next year, we're expecting a 10% increase. So that'll be 4 years in a row of double-digit gains. It doesn't come with a money-back guarantee, but we're feeling pretty reasonably confident about that. And you'll see that there have been times in the past when we've had three consecutive increases and four consecutive increases. So that's not that crazy. Um, Also not crazy is industry analyst expectations for earnings. This is operating earnings per share. We monitor this for you every single week. We try to show you this chart. PE times E. This is the E. We're using forward earnings, which is time weighted average of this of the current year and the coming year. So we're at the end of the year, we converge to the coming year expectations. So it's around $312 a share. And then next year, the expectations is $357 a share. We're expecting $350 a share. So the analysts are pretty bullish. You can see here that the 2024 number kind of settled down and went flat. Same thing for 2025, 2026. And here, they're really pretty excited about 2020, 2027 and relatively excited about 2026. And we kind of agree with them. I mean, this is kind of a nice roaring 2020s kind of scenario. This is revenues. The revenues expectations are from here to here, 25 to 26, and then 26 to 27. You can see the numbers here, but they translate to 7% increases in revenues this year, this coming year, and next year. Now, 7% seems awfully high since the average growth rate of revenues is 4.5%. However, if you agree with the roaring 2020 scenario, no recession, then the average, excluding the recessions, is obviously going to be higher than 4.5%. I'm going to have to do the math on it, but it's got to be easily 7%. 7% is kind of consistent, I guess, with global nominal economic activity. But anyways, this is the S&P 500, and these companies are pretty good at finding revenues. This is the profit margin expected to be at an all-time record high in 2027 of 15.4. It's going up to 14.3 according to the analysts' expectations. Here's the forward profit margin. The bottom line of it, though, is this is again a roaring 2020 scenario. It's not my scenario. I mean, it's consistent with my scenario, but this is what the analysts think. I don't think I've had that kind of influence on them that they all bought into the roaring 2020s, but they seem to be buying into it from their own perspective. This is the quarterly numbers for this year. You can see the analysts for this is where's first quarter. First quarter, see how the analysts got spooked by tariffs, lower their number, and then it turned out to be this is the so-called earnings hook, turned out to be much better. Second quarter was even worse. See how they cut their estimates for the growth rate, and then it turned out to be much better. Well, then they got the hang of it, said, okay, we're not as scared of tariffs and bad stuff, and so they kind of hung in there. This is actually the that was the third quarter. The third quarter was they kind of hung in there, and then boom, turned out to be amazing. And now in the fourth quarter, again, they're actually raising their estimates. And I'm wondering whether the government shutdown might turn out to not give us another big hook there. And maybe so in January, February, we'll get a disappointment there. Maybe we'll get the bond market not too happy with all these payments being made by the government. And so I'm looking for something to worry about. Can't always be upbeat, or if you're going to be upbeat, you got to at least consider what could go wrong. And so we try to do that. This is 2026 S&P, and you can see that the growth rates recently have all been moving higher. So they're pretty bullish, the analysts. This is our update of forward earnings versus S&P 500 versus the 493, and you can see that the S&P 500 has been boosted by the Magnificent Seven, but the impressive 493 have also performed pretty well. I have more, but you know what? This is kind of work in progress, so I'll write it up and we'll send it to you when things are kind of there isn't a lot of data coming out. But this is will mid caps outperform in 2026, and we're kind of doing same kind of analysis on earnings. You've seen this chart before. This is S&P 500 forward. Let me see. That's close to what I want. This is it. S&P 500 forward operating earnings, and that shows you that the small cap, mid cap have been kind of flat, whereas this one has been the S&P 500 has been very strong. So let's take a couple of quick questions here. One of these days I'll do it all in half an hour. Let's see, Lee, you've mentioned in the past three sectors you consider to be candidates for performing best in the S&P: healthcare, financials, and industrials. True. Two questions. Do you think that these sectors will be beneficiaries from the AI progress more than others? And are other sectors you think will outperform the tech and communication sector? Yeah, I'm going to stick with those three. And yeah, the answer is yes. I think they have tremendous potential for using AI technologies and any other technologies out there to improve their productivity. We all know that from healthcare. We all experience that on a regular basis, the lack of productivity there. But that's changing. You know, you go into and wait for the doctor. You're filling out the information on an iPad. Now you increasingly you can do it on your smartphone, and there's now at least in New York, I think there's something called Epic, where you know if you have a unfortunate relationship with two or three hospitals, and you had kidney stone removed in one or an appendix removed in another, and you had to physically go and get the records when you went to one or the other. You don't have to do that anymore. All the records are in one place. Um, and then I think, I don't know, Sam Altman keeps saying that, oh boy, if we had all these data centers right now, we could cure cancer. I think he's a bit of a hypester. But I think that it is going to have um, tremendous implications for processing, medical data a lot faster and coming up with conclusions, whether it be drugs or, you know, diagnosing people for what they have. What do you see as investors positioning in gold? How underweight or overweight? I have no clue. All I can tell you is for a while there, the story was the central banks of bad countries or countries that don't have the same interest in geopolitical interests as the United States. That those central banks have decided to load up on gold. Um, but you have to believe that, well, we know that I'm on Indian TV about two, three times a week. Don't ask me how that happened, but I am. I guess it's because I stay up late and it's easy to do. But last night I reiterated my $10,000 an ounce call, so maybe I have something to do. You know, I'd like to imagine that I had something to do with the gold rally this morning. But yeah, I think people in India have always, quite a few of them have always viewed gold as an asset that they want to have some of. And then I think Chinese investors got clobbered in the property market. Yeah, the stock market's doing better there, but they kind of realized over the years that it's really for trading, and you can really can really swing you all over the place. And gold looks like a nice steady climb to the upside, getting a little bit faster, but percentage-wise, it's pretty consistent. And I do, by the way, I think I did put that chart on the ratio scale. Can you discuss your thoughts on silver? Hi ho, silver away. I mean, for those of you who remember the Lone Ranger, that seems to be the story there. Silver has more fundamentals going for it than gold does. Silver is used a lot in electronics, and so that silver probably makes more sense than gold. But I think the precious metals are just going to continue to work. And then one last one: does the Roaring Twenties scenario end badly like the 1920s? That's a good question to end on, actually, for today. I mentioned this before that whenever I talk about the Roaring 2020s, the pushback I get is that, well, that didn't end very well. Um, and so one of my responses is, well, if this doesn't end well, you better make a lot of money before it doesn't end well, and then let's just cash it all in and try to stay out of trouble. But no, seriously, I think I mean, history repeats itself. Sometimes it just rhymes. I think what caused the Great Depression is the Smoot-Hawley tariff that was passed in May 1930. Stock market did not crash in 1929. It had a pretty significant sell-off, but it completely rebounded 50% and was back to where it was in April of the previous year. In May, it was back of 1930. So what's the big deal? And the big deal is Smoot-Hawley was passed, and that's when the great crash really started around the world. Stock markets plunged, commodity prices plunged, mortgage debts generally defaulted. So that's what caused that. We just had a bit of a stress test. Some people compared what Trump did to the Smoot-Hawley tariff, but the global economy didn't. We didn't get massive retaliation. We didn't get a shut off of world trade. We haven't really gotten deglobalization. We've got kind of rebalancing of globalization. So I don't think it'll end badly, but honestly, I do. When I follow what's going on geopolitically, I do kind of have some concerns about that the 2030s could possibly be like the 1930s. Obviously, there's some historical comparisons already, but for now, I prefer to think that so far so good on the Roaring 2020s. If this works out, let's try the Roaring 2030s and put a 1930s scenario for the 2030s as a risk, hopefully a small risk. Well, with that relatively upbeat view, have a Merry Christmas. I guess Hanukkah is basically over. Have a great New Year, and I don't know. I kind of been enjoy meeting with you, so let's do this again next week on Monday if you're in the mood. Thanks a lot. All the best.